I'm Daniel.
And I'm Mira.
So today, we are looking at a world that, frankly, it just defies basic financial gravity at this point.
Oh, completely. It's wild out there.
I mean, you look at the S&P 500, right? It's currently projecting this massive, incredibly bullish, like 16% earnings growth for 2026.
Yeah.
But then, simultaneously, you've got gold blasting past historic highs, like, what, $4,850 an ounce?
Exactly.
Because institutional investors are just terrified of a total systemic breakdown. I mean, you have unprecedented government stimulus colliding with a completely paralyzed central bank.
Right, and literal naval mines ripping apart global supply chains.
Yeah, exactly. Literal naval mines. So if you usually tune into our daily show, we cover the rapid fire moves, right? The immediate reactions to the latest data prints. But this is a special weekend edition.
Yeah, we're taking a breath.
Right. We are stepping back from the intraday noise to really decode this highly volatile, totally fractured 2026 macroeconomic landscape.
Yeah.
And to do that, we are using a massive new macro equity strategy document as our guide.
Yeah.
We really want to figure out the underlying architecture of this market.
And before we unpack all the mechanics of this landscape, it is really crucial to state clearly, this deep dive is strictly for market context and broad macroeconomic discussion.
Right.
This is not personal investment advice, and we are not making any investment recommendations. We are just here to map out the forces driving the tape, not to tell you what to buy or sell.
Exactly. Good disclaimer. So let's just start right at the top with the foundational question. Session 1. What regime are we actually in now?
Yeah, that's the big one.
Because if you look at the research, the underlying thesis is that the macroeconomic environment we all got incredibly comfortable with back in the 2010s is just, it's completely irreversibly dead.
Oh, it's entirely dead. The autopsy on the 2010s is complete, and the cause of death was basically structural reality. I mean, think about how easy that decade was for asset allocators.
Oh, there was a joke. You could just throw a dart.
Right. It was defined by the Great Moderation. So low economic growth, persistently low inflation, and globally synchronized markets. You could literally just buy an index fund, go to sleep, and wake up wealthier.
Mostly because of zero interest rate policy, right?
Exactly, ZRRP. There was this deeply embedded assumption that if things ever got even slightly unstable, central banks would just drop rates back to zero and print money. But that era, the era of frictionless globalization and mean reverting interest rates, it is over.
So if the 2010s are dead, what exactly is the monster that has replaced it? Because the strategy document points to a massive paradigm shift, and it outlines 3 very specific pillars that define this new reality.
Right, and these 3 pillars are basically the anchor of everything we're going to discuss today. So first, we are witnessing an acyclic capital expenditure cycle.
Acyclic, meaning not tied to the usual cycles.
Yes. Massive corporations are spending hundreds of billions of dollars on infrastructure completely independently of consumer demand.
Wow. Okay, what's the second?
Second, we have aggressive pro-cyclical fiscal dominance, meaning the U.S. government is deploying massive economic stimulus despite the fact that the economy is already sitting at full employment.
Which usually you'd only see in a recession.
Exactly. And third, we have profound geopolitical fracture. Supply chains are no longer optimized for cost. They are being actively weaponized for national security.
So if you are listening to this, you might be asking, okay, 3 big macro pillars, but what is the actual net result of those colliding?
Right.
And the answer the data gives us is total violent divergence. Specifically, it's an environment that almost aggressively favors U.S. exceptionalism.
Yeah, the U.S. is just pulling away.
Right, because the United States is experiencing above-trend growth.
Yeah.
Like the IMF recently revised U.S. GDP growth for 2026 upward to 2.4%.
Mm-hmm.
But then you look across the Atlantic, and Europe is essentially stagnating. They're suffocating under near-recessionary conditions.
And this brings us to the core transmission mechanism of this entire regime. How does a fractured macro landscape translate into the stock prices you actually see on your screen? The report uses a term I find fascinating. They call it high grading.
High grading.
Yeah. The market has become utterly ruthless in separating the wheat from the chaff. It is heavily rewarding companies that can transition into high-margin, capital-light business models by leveraging artificial intelligence.
So if a company has absolute pricing power, domestic insulation, and a strong balance sheet, investors are assigning it this massive premium multiple.
Exactly. And the flip side of high grading is essentially a death sentence for the rest of them.
Right. If you are a legacy company carrying high capital costs, or you're heavily reliant on expensive human labor, or dangerously exposed to international supply chains that are currently being ripped apart, the market is punishing you severely.
It's brutal out there.
It's not a rising tide lifting all boats. It's more like a lifeboat scenario in a hurricane. If you aren't pulling your weight, the market is just throwing you overboard.
And the proof of this high grading is sitting right in the corporate profit estimates. Remember that 16% EPS growth projection for the S&P 500 in 2026?
Yeah, that massive number.
Right. That is the strongest profit expansion we've seen since the immediate post-pandemic rebound. But, and this is key, that 16% is a highly distorted average.
Because it's top-heavy.
Exactly. It is heavily concentrated in the top tier of companies building or utilizing this new tech infrastructure. The bottom 400 companies in the index are basically fighting just to keep their margins flat against rising input costs.
Okay, all right, this is where I have to step in and push back a little on the academic neatness of this whole framework.
Oh, here we go.
Yeah, this is theory A for me. The neatness of textbook models versus the actual reality of the tape. I mean, I read the report. It says, we are in a new structural regime, and the market is rationally pricing these divergent long-term cash flows.
Right.
But as a practitioner, I look at my actual terminal on a Tuesday afternoon, and I see the S&P 500 swinging 400 points in a single day based on a single, vaguely worded headline crossing the wires. Let's be real here. The intrinsic value of the 500 largest, most complex companies in America does not actually change by 4% between breakfast and lunch.
No, of course not.
Those violent, rapid intraday swings are not rational repricings of a new regime. They're emotional algorithms panicking, stop-loss triggers firing in cascade, and sudden liquidity vacuums where buyers just vanish.
Okay, you're pointing to the chaos of the microstructure, and you aren't wrong about how messy it is. I totally can see that daily whiplash is purely emotional.
Exactly.
But to dismiss the macro framework because the intraday action is chaotic is to miss the forest for the trees. Yes, a 400-point swing driven by a headline is emotional. Yes, algorithms overshoot and human panic creates temporary liquidity vacuums.
Right.
But when the dust settles, when the algorithms exhaust themselves and the stop losses are cleared, where does the market find its floor?
It finds an anchor.
It anchors right back to the structural realities of high grading. The S&P 500 doesn't snap back to 2019 valuations. It snaps back to the reality of the 16% earnings growth driven by U.S. exceptionalism. The daily whiplash is the noise. The regime we are mapping out today is the signal.
Okay, fair. I'll agree that the long-term anchor exists, but man, the road there is paved with a lot of irrational human behavior.
Very true.
But let's summarize session 1 briefly. Basically, the old 2010s playbook is totally dead, and U.S. equities are ruthlessly high grading based on this new structural reality.
Yes, that's the baseline.
Perfect. We're going to take a very short break, but stick around, because when we return, we are going to examine the exact specific engine that is driving all of this U.S. growth.
See you in a minute.
And we are back.
Welcome back. Let's dive right into session 2. Why is AI, Capex, and electrification still one of the main engines of this market?
Yeah, let's get into the numbers here.
So it's really because of the sheer unprecedented scale of the capital being deployed. We touched on this idea of a cyclic Capex earlier, but we really need to put real numbers on it.
Right.
Traditionally, capital expenditure is highly cyclical. Think about like a car manufacturer. If consumer confidence is high and people are buying trucks, the manufacturer invests billions to build a new factory.
Makes sense.
But if the economy dips, they halt construction. It's a feedback loop tied directly to the consumer's wallet. What is happening in 2026 is entirely different. We are currently tracking a $700 billion acyclic Capex cycle.
$700 billion.
Wow. That is a 36% year-over-year increase, and it is completely untethered from the broader consumer economy.
Untethered is definitely the key word there. I mean, we are talking about tech giants and industrial conglomerates essentially building an intercontinental railroad. You don't pause laying tracks just because ticket sales for a stagecoach were down last month, right? You lay the tracks, because if you don't connect the two coasts, your entire business model is dead in 10 years. It's an existential arms race. But what exactly are they building that requires $700 billion?
They are building the infrastructure for agentic AI.
Oh.
And we need to draw a really hard line here between what AI was in, say, 2023 and what it is in 2026.
Oh, completely different worlds.
A lot of people still hear artificial intelligence and they think of a chatbot, something you prompt to write a polite email or generate a picture of a cat on a skateboard. Large language models were impressive, but they were essentially digital assistants waiting for human instructions.
Right.
Agentic AI refers to systems capable of autonomous planning, multi-step reasoning, and independent execution without human oversight.
All right, so we're talking about a digital agent that doesn't just draft the vendor contract, but it actually reads the counterparty's revisions, models the financial risk of those revisions, negotiates the terms, signs the agreement, and then independently updates your company's accounting software to reflect the new liabilities.
Exactly.
The computing power required to train a model to do that, to give it an internal monologue and reasoning capabilities, is exponentially larger than the power required for a simple text generator. That is where the $700 billion is going.
Yes. And the macro data is finally proving that this isn't just some science project. It is translating into real economic value. We are seeing a structural elevation in total factor productivity, or TFP.
Okay, let's translate TFP for the listener.
Right.
Because economists really love to throw that acronym around.
They do.
An economy basically grows in three ways, right? You add more workers, you add more capital like machines and factories, or you just get better at using the workers and machines you already have. That third bucket, getting more output from the exact same inputs, is total factor productivity. It is the holy grail of economics, and it has been really sluggish for decades.
Well, until now, because the integration of agentic AI is creating a massive TFP multiplier. But what is truly concerning from a global perspective is how this is creating a severe readiness divide.
Oh, yeah. Who gets left behind?
Exactly.
Yeah.
The productivity gains are highly localized. The United States, Japan, and Singapore currently possess the robust digital infrastructure, the immense capital markets, and crucially, the electrical power grids required to capture this value.
The power grids are huge.
They are. Meanwhile, developing nations and even parts of Europe that lack the computing resources and energy capacity are being structurally left behind. The report notes that an astounding 2/3 of the entire U.S. equity market cap sits in the highest tier of AI adoption readiness.
It's a sovereign-level rich-get-richer dynamic.
Definitely.
But let's make this tangible for a second. Let's step out of the macro clouds and look at how this is transforming specific sectors right now.
Healthcare is the absolute prime example of this transformation. In biopharma, companies are actively using these advanced models for precision molecular design.
Good.
So instead of the old model, where scientists mix compounds in a physical lab for a decade, just hoping to find a viable drug, AI agents are digitally simulating how millions of unique compounds will interact with a specific disease target at the atomic level.
Which is insane to think about.
Right. They are predicting efficacy and toxicity before a single physical chemical is ever synthesized. The long-term projections suggest this will strip between $100 billion and $600 billion in R&D costs out of the system by 2050.
That's massive.
And on the operational side, hospitals deploying agentic AI for clinical staffing optimization, supply chain management, and predictive patient flows, that is projected to drive another $300 billion to $900 billion in structural savings.
Wow. And what happens when AI steps out of the server farm and enters the physical world?
You get embodied AI. Humanoid robots powered by these exact same autonomous brains. And this isn't science fiction anymore. It is a measurable industrial pipeline.
Right.
The projections model embodied AI becoming a $5 trillion market by 2050. Think about the macroeconomic implications of that. If you can deploy a humanoid robot to handle logistics, warehousing, or basic assembly, you are fundamentally altering the long-term dynamics of labor wage inflation. You are establishing a hard technological ceiling on how much repetitive human labor can actually cost.
Okay, I'm going to stop you right there. Because this is where I have to invoke Theory B, the illusion of instant information diffusion.
Oh, the timeline argument?
Yes, because I hear you throwing out these numbers. A $700 billion Capex cycle today. That is real. The money is leaving corporate treasuries right now.
Yeah.
But then you seamlessly transition to talking about $600 billion in hospital savings by 2050, or a $5 trillion humanoid robotics market a quarter of a century from now. The market, and by market I mean this humans and algorithms trading today, is severely mispricing the timeline of this revolution.
why you say they are mispricing it. I mean, the stock market's entire function is to act as a forward-looking discounting mechanism. It is supposed to price in future cash flows today.
Sure.
If you wait until the robot is actually sweeping the factory floor to buy the stock, the alpha is entirely gone.
Yes, it's a discounting mechanism, but human participants have bounded rationality. They hear robotics revolution in 2050, they get a hit of dopamine, and they immediately attempt to extrapolate a 25-year structural societal shift into a stock price for Q2 of 2026.
Well,
Like, building a functional humanoid robot in a lab is an engineering problem. Getting 50 different regulatory bodies, labor unions, insurance actuaries, and safety inspectors to agree to let that robot operate autonomously on a busy factory floor right next to humans. That's a deeply human, bureaucratic, incredibly slow process.
that's true.
True technological diffusion takes decades. Look at autonomous driving. We were promised robo-taxis by 2018, and it took vastly longer to navigate the edge cases and the legal liabilities. When retail traders and momentum algorithms price in absolute perfection on a 25-year timeline today, they create messy, highly tradable inefficiencies. The timeline is the trap.
Okay, I will grant you that the market routinely underestimates the friction of human bureaucracy. The regulatory S-curve is always flatter and longer than the technological S-curve. That mismatch definitely creates pockets of severe, dangerous overvaluation in the most hyped equities.
Exactly.
But even if the market is aggressively pulling forward that 2050 value, you really cannot ignore the physical reality of the $700 billion being spent today. To build the future, even if it arrives 5 years later than the market expects, requires a staggering, immediate consumption of physical capital, servers, and electrical power. The spending is happening now, regardless of when the regulatory hurdles are actually cleared.
Fair point. I'll concede that the scale of the cyclic AI build-out is massive, and it requires a staggering amount of capital and power today.
Exactly.
So to quickly wrap up this session, the AI Capex cycle is a $700 billion physical reality happening now, even if the market gets a bit ahead of itself on the timeline for robots and hospital savings.
Well summarized.
All right, we are going to take another quick break, but when we come back, we'll explain how the U.S. government is actually quietly subsidizing this massive tech build-out through a brand new piece of legislation. Stay tuned. Welcome back to our weekend deep dive. Let's jump right into session 3. How is fiscal dominance reshaping growth, inflation, and rates?
This is such a critical piece of the puzzle.
Because if you were listening to this and looking at your portfolio, you're probably asking yourself, how is the U.S. economy sustaining this level of growth and corporate spending without overheating entirely?
Right.
And to understand that, you really have to understand a piece of legislation passed in July 2025, the One Big Beautiful Bill Act, affectionately known as the OBBBA.
Oh, the OBBBA. It is a masterclass in aggressive, pro-cyclical fiscal policy, and we really need to distinguish that from traditional government action.
How so?
Usually, massive fiscal stimulus, think deep tax cuts or multi-trillion-dollar infrastructure spending, is deployed counter-cyclically. When the economy crashes into a recession and the private sector pulls back, the government steps in with a fire hose of money to replace that lost demand and stimulate growth.
Right, like 2008 or 2020.
Exactly. But the OBBBA does the exact opposite. It is stepping on the gas pedal of an economy that is already cruising at 80 miles an hour. It is heavily stimulating a system that is already operating at full employment.
And when you stimulate at full employment, you risk blowing the engine.
Exactly.
But let's look at the actual mechanics of the bill. What are the specific provisions inside the OBBBA that are supercharging the tape right now?
The scope of the legislation is honestly breathtaking. On the corporate side, the crown jewel is making 100% bonus depreciation permanent, alongside retroactive R&D expensing. And for the consumer, it is deeply populist. It completely eliminates federal income taxes on both tips and overtime pay. It introduces a brand new $6,000 above-the-line tax deduction specifically for seniors. And it establishes Trump accounts, which are basically government-seeded savings accounts designed to build equity for children.
Okay, let's slow down and unpack that 100% bonus depreciation, because this is the invisible hand subsidizing the AI boom.
Yeah, it really is.
Imagine you are a major tech company and you decide to build a $5 billion data center. Under the old traditional tax rules, you would have to slowly write off the cost of that facility over 15 or 20 years. It's a slow trickle of tax relief.
Right.
But under the OBBBA's 100% bonus depreciation, you get to deduct that entire $5 billion from your taxable income in year one. It essentially wipes out a massive portion of your tax liability immediately. It massively lowers your cost of capital and floods your balance sheet with instant liquidity. The government is literally directly underwriting the risk of the AI Capex cycle.
It is an absolute earnings accelerant for capital-intensive industries. But, you know, in macroeconomics, there's no such thing as a free lunch.
Never.
The short-term corporate euphoria is masking a terrifying long-term cost. The Congressional Budget Office projects that the OBBBA will add between $4.1 trillion and $5.5 trillion to the national debt over the next decade.
$5.5 trillion, that is a heavy number.
We are pushing the U.S. debt-to-GDP ratio well past 125%. To put that in perspective, it means the United States is now structurally locked into running budget deficits of 7% to 7.5% of GDP indefinitely during peacetime and economic expansion.
And how does that massive, relentless deficit spending collide with the inflation data?
Violently. When you pump trillions of dollars of populist stimulus into a full employment economy, giving workers tax-free overtime to spend while subsidizing corporate mega projects demand just massively outstrips supply.
Right.
The inflation data is flashing red. U.S. headline CPI for March 2026 just surged to 3.3%. And a massive driver of that was gasoline, which spiked an astonishing 21.2% in a single month.
Wow. So inflation is running hot again, sitting stubbornly above the Fed's 2% target. You have 3.3% CPI and 7% deficits. This is the exact scenario where the Federal Reserve is supposed to step in and hike rates to cool the party down.
Supposed to.
But they aren't. They are completely paralyzed.
They really are. They executed a decidedly hawkish pause at their March meeting, holding the federal funds rate exactly where it was at 3.50% to 3.75%. Any lingering hopes the equity market had for a return to easy money or an imminent cycle of rate cuts have been violently pushed deep into 2027.
Yeah, totally repriced.
The Fed is trapped in a vice. If they hike rates to fight the 3.3% inflation, they risk crushing the Treasury market because the government has to issue trillions in new debt to fund the OBBBA. If they cut rates, inflation spirals completely out of control, so they do nothing.
But it's not just the economic data paralyzing the Fed. And this is exactly where the algorithmic textbook models completely fall apart, in my opinion.
Oh, for sure.
An algorithm can ingest a 3.3% CPI print and instantly calculate an adjusted terminal rate. What an algorithm cannot do is price in the human game theory of a political constitutional crisis happening in Washington right now.
We have to talk about the leadership transition at the Federal Reserve.
The political dynamic is incredibly fraught right now.
Jerome Powell's term as Fed chair expires next month in May 2026. But he isn't just gracefully retiring. He is currently the subject of a highly controversial Department of Justice criminal probe regarding severe cost overruns on a $2.5 billion building renovation project.
Right.
Now, in response to this impending vacancy, the president nominated Kevin Warsh to take over the central bank. But here's the wrench in the gears. Republican Senator Tom Tillis, who sits on the Critical Banking Committee, is explicitly blocking Warsh's nomination. Tillis has publicly stated he will not allow the confirmation to move forward until the DOJ entirely drops the probe into Powell. It is a complete, unprecedented legislative standoff over the most powerful financial institution on earth. And we must be explicitly clear for the listener here. We are not taking political sides here.
Absolutely not.
We are not evaluating the merits or flaws of the OBBBA legislation, nor are we taking any position on the validity or nature of the DOJ probe into Chairman Powell. Our job is strictly to analyze how these intense political realities act as direct transmission mechanisms that flow into Treasury yields, bond market pricing, and equity multiples.
Exactly. Thank you for that impartiality check. Think about this from the perspective of an institutional bond buyer. If you are being asked to lend the U.S. government billions of dollars for the next 10 years, you look at the landscape, you see the OBBBA generating $5 trillion in new debt, you see inflation at 3.3%.
Right.
And then you look at the Federal Reserve, the institution that is supposed to manage this chaos, and you realize nobody knows who will legally be allowed to steer the ship 6 weeks from now.
It's terrifying for bondholders.
It creates what we call a massive structural term premium expansion. Let's use an analogy. Imagine you're offering a fixed-rate mortgage to someone, but you hear a rumor that the entire neighborhood might be rezoned for a toxic landfill in 2 years. Are you going to give them a standard interest rate?
No, absolutely not.
No, you are going to demand a much, much higher yield to compensate for the extreme uncertainty of locking your money up in that environment. That is what bond vigilantes are doing to the Treasury market right now. The term premium is exploding because the political paralysis makes long-term risk completely unquantifiable.
The bond market is demanding to be compensated for a ship with no captain heading into a fiscal storm.
Perfectly said. So to wrap up Section 3, basically, pro-cyclical fiscal policy is totally juicing corporate earnings, but it's destroying the Treasury curve and politically paralyzing the Fed.
Yep, that's the long and short of it.
All right, we are going to take our final short break. When we return, we will look offshore because domestic inflation is only half the story. The global supply shocks are waiting. We're back. Let's dive into Session 4. How are geopolitical fracture, tariffs, and supply chain rewiring changing the macro map?
Yeah, because we've talked about the death of the 2010s, but the most visually striking evidence of that death is the physical rewiring of global trade. The era of frictionless, optimized supply chains is dead.
It's totally over.
What we are witnessing is the explicit weaponization of global trade. Economic efficiency, the concept of just-in-time logistics where parts arrive at a factory hours before assembly to save warehousing costs, that has been entirely subordinated to national security.
Right.
The most immediate catalyst for this in 2026 is the massive structural shift in U.S. tariff policy. We have moved from targeted skirmishes to a fortress economy. The U.S. now enforces a baseline 10% tariff on all imported goods. And when you layer on the aggressive, country-specific incremental tariffs aimed at strategic competitors, the effective global tariff rate is threatening to hit an unbelievable 22%.
22%. That is, just a year ago, in early 2025, the baseline effective rate was hovering around 3%.
Yeah.
That is a staggering, violent jump in the base cost of moving a physical object from one side of the planet to the other.
It fundamentally breaks the math of global manufacturing. It is forcing multinational corporations into what the strategy report labels Phase 2 of capacity migration.
Phase 2. What was Phase 1?
Well, Phase 1 was relatively straightforward. We saw this over the last few years. Companies just moved their factories from primary adversaries like China to friendly secondary hubs like Mexico, Vietnam, or India. It's called friendshoring.
All right.
But Phase 2 is vastly more difficult. Phase 2 requires the outright repatriation of highly complex, high-tech manufacturing directly back to the United States or its absolute closest security allies.
And let's be real clear about what repatriation actually costs. Building a state-of-the-art semiconductor fabrication plant in Ohio is vastly more expensive than building one in Taiwan or Southeast Asia.
Oh, infinitely more expensive.
The environmental permitting alone takes years, the union labor is significantly more expensive, and the local supply chains for specialized parts simply don't exist yet. The repatriation process is wildly, structurally inflationary. It ruthlessly compresses the corporate profit margins for any company that lacks the absolute pricing power to pass those massive new costs directly onto the consumer.
Exactly. But tariffs and factory relocations are a slow, grinding burn. To truly understand why inflation spiked to 3.3% this spring, we have to talk about the acute shock, the event that set the global energy data on fire.
Yeah.
We have to discuss the 2026 Iran war.
The ultimate geopolitical black swan that honestly wasn't really a swan at all, given the tensions.
Precisely. On February 28th, a joint U.S.-Israeli military strike resulted in the assassination of Iranian Supreme Leader Ali Khamenei. The global geopolitical risk premium exploded instantaneously.
Naturally.
And in immediate hardline retaliation, Iran executed a functional blockade of the Strait of Hormuz.
For those who might not stare at nautical maps all day, the Strait of Hormuz is arguably the single most vital maritime choke point on the entire planet. It is a narrow strip of water between the Persian Gulf and the Gulf of Oman. At its narrowest point, the shipping lanes are only 2 miles wide in either direction.
It's tiny. And through that tiny bottleneck flows roughly 20% of all global oil consumption. The economic disruption of its closure was instantaneous and brutal. Brent crude oil surged violently past $100 a barrel. European natural gas and liquefied natural gas prices spiked by 50% almost overnight.
It's crazy.
But the narrative in the financial press heavily focused on energy, ignoring an equally terrifying consequence. The blockade completely severed the global supply chain for critical agricultural inputs.
Oh, let's dig deep into that agricultural angle, because I think the fertilizer shock perfectly illustrates how asymmetrical this geopolitical fracture really is. Like, not everyone feels the pain at the exact same time.
It's a fascinating dynamic. Roughly 1/3 of all seaborne traded fertilizers, the critical nitrogen, phosphorus, and potassium mixes required to grow modern food at scale transit through the Strait of Hormuz.
Wow. 1/3.
When that strait closed, the impact hit different sovereign nations on entirely different timelines based on their agricultural calendars. U.S. farmers, for instance, generally had their chemical inputs secured and sitting in silos over the winter for the spring planting season.
Right, so they were okay for now.
So for the U.S. agricultural sector, the blockade primarily represents a pricing risk for the 2027 crop year. They have a buffer.
But look at the southern hemisphere. Look at Brazil.
Exactly. Brazilian farmers operate in the Cerrado, a massive savanna region that requires immense, constant fertilizer application to maintain high crop yields. They are heavily reliant on immediate just-in-time fertilizer imports to prepare for their massive September 2026 soybean plantings.
Oh, man.
They don't have a buffer. They are facing an immediate existential physical supply shock right now. This threatens to absolutely crush Brazil's global export competitiveness and send global food prices skyrocketing by the end of the year. One single geopolitical event, two completely different economic timelines.
And this brings me right back to the human element, the game theory of it all. Because the market, specifically the algorithmic trading complex, is currently tying itself in knots, trying to price in the resolution of this conflict.
They always do.
Right now, as we sit here in mid-April, there are massive high-stakes peace talks happening in Islamabad. You've got U.S. Vice President J.D. Vance, Special Envoy Steve Witkoff, Jared Kushner, all sitting across a table from Iranian negotiators like Mohammad Bagher Ghalibaf. The trading algorithms ingest the Raiders headline. Diplomats meet in Islamabad for constructive dialogue, and they immediately start violently selling off oil futures. They're pricing in a ceasefire and a return to normal shipping.
Because the model assumes a political ceasefire means the strait reopens tomorrow and the oil flows the day after.
Right. But practitioners, people who actually understand logistics, look at the physical reality on the water. When the conflict kicked off in late February, Iranian naval forces haphazardly deployed hundreds of sea mines into the strait. These aren't just floating barrels. These are advanced acoustic, magnetic, and pressure-triggered mines.
Highly dangerous.
And according to naval intelligence reports, the Iranians deployed them so frantically that they literally lost track of their own minefields.
Oh, wow.
You cannot sign a diplomatic piece of paper in Pakistan to make highly lethal, untraceable sea mines magically vanish from the water. You can't cancel a physical threat with a political treaty. The physical clearing of those shipping lanes will take months of highly dangerous, incredibly slow, specialized naval minesweeping operations. The algorithms are fundamentally mispricing the duration of this logistics snarl because they equate a political signature with physical maritime safety.
Which means the shipping delays, the massively elevated freight rates, and the exorbitant maritime insurance premiums are going to persist far, far longer than the consensus currently believes. The inflationary pulse isn't over just because politicians shake hands.
Exactly. All right, that flows nicely into our next big topic. Because with the regime, the engines, the fiscal policy, and the geopolitics all mapped out, it's really time to see how you actually invest in this mess.
Let's get into the application. Session 5. How is this regime flowing into equities, sectors, and less crowded opportunities? How do you actually put money to work in this environment without getting destroyed?
Right, because that's what everyone really wants to know.
Let's start by zooming out from the U.S. and looking at how high grading plays out on the international level. The divergence between sovereign markets is profound. As we discussed, the United States is relatively insulated. It possesses domestic energy production, food security, and the OBBBA is providing a massive, albeit debt-fueled, fiscal tailwind.
A huge tailwind.
But Europe is trapped in an entirely different, deeply painful reality.
because Europe spent the last 2 decades relying on cheap Russian pipeline gas to fuel its industrial base. When that was cut off, they pivoted to relying on cheap, global liquefied natural gas delivered by ships.
And now those LNG ships are trapped behind a blockade in Hormuz. Europe is highly sensitive to that 50% spike in natural gas prices. Because they are importing inflation through energy costs, the European Central Bank is trapped.
We're totally stuck.
They're being forced to keep monetary policy incredibly tight to fight off peak inflation estimates of 4%. Current forecasts show the ECB might be forced to actually hike rates 3 times this year.
So the ECB is hiking interest rates directly into an energy-driven industrial slowdown. That is the textbook definition of stagflation. It's a recipe for near-recessionary conditions, and European corporate earnings are facing severe, relentless downward revisions as a result. Capital is fleeing Europe.
But there is a massive, incredibly lucrative bright spot internationally, and it's a story of pure structural transformation. Japan.
Oh, Japan is fascinating right now.
The report highlights Japan as a regime change thesis. For the last 30 years, Japan was trapped in a stagnant demographic deflationary spiral. Their corporate culture was incredibly defensive, hoarding cash and relying on inefficient cross-shareholdings.
Right.
But the recent global inflationary wave has actually been a massive gift to Japan. It shocked their system and helped them break out of that deflationary mindset. They are finally experiencing sustained nominal GDP growth, and this has catalyzed sweeping corporate governance reforms mandated by the Tokyo Stock Exchange.
Long overdue reforms.
Japanese conglomerates are being forced to abandon their old, capital-heavy, inefficient models, unwind their cross-shareholdings, and become aggressively more shareholder-friendly through buybacks and dividends.
And what's truly fascinating is how Japanese assets are behaving relative to the rest of the world. In the US or Europe, when government bond yields go up, equity markets usually panic and sell off because the discount rate on future earnings is higher.
Right, usually an inverse relationship.
But in Japan, right now, Japanese equities are actually appreciating synchronously alongside rising Japanese government bond yields. It is an incredibly rare international asset class that is actively benefiting from both the global inflationary regime and the geopolitical reshoring of manufacturing away from China.
It's a phenomenal diversification play.
Yeah.
But if we bring the focus back domestically to the core AI theme, we have to look beyond the obvious. You can't just buy the major tech giants forever. The multiples eventually become prohibitive.
They get too crowded.
You have to look at the extensions of that trade. You have to look at the physical constraints of their ambition.
So we're talking about the electrification supercycle here, because the AI dream is completely, fundamentally bottlenecked by physical reality. These massive agentic AI data centers require astronomical amounts of power. We were talking about facilities that draw up to 10 times more electricity than a traditional cloud storage or internet search facility.
And the existing global power grids are completely exhausted. They simply cannot handle the projected load.
No way.
In response to this existential bottleneck, we are witnessing a massive, fiercely funded global nuclear renaissance. The forecasts for new global nuclear capacity additions by 2050 have just been revised upward by 53%.
53%.
We are looking at 586 gigawatts of new capacity, which represents a potential $2.2 trillion investment cycle across the entire nuclear value chain, from uranium miners to small modular reactor designers.
And this isn't just free market ambition. The OBBBA fiscal stimulus is explicitly backstopping this entire industry, isn't it?
Absolutely. The legislation creates incredibly lucrative tax shields specifically for advanced nuclear facilities. It legally allows them to form master limited partnerships or publicly traded partnerships.
Oh, MLPs. For the listener, this basically means these nuclear entities can pass their income directly to investors without paying corporate-level taxes.
Yeah.
It massively increases their yield and attractiveness to private capital.
Furthermore, the bill grants a $6 billion expansion for direct federal loan guarantees to ensure these facilities can secure the massive upfront financing required to break ground.
But generating the power is only half the physical constraint. Once you split the atom, you still have to move that electricity from the nuclear reactor to the server rack. And that transmission requires copper. Miles and miles of physical copper wire. Data centers alone are projected to consume an astonishing 475,000 metric tons of copper this year.
And the supply side simply isn't there to meet it.
It's not even close. You can't just magically spawn a copper mine. It takes an average of 15 years from discovery to commercial production due to environmental permitting and capital constraints. Right now, global legacy mines in Chile and Peru are facing rapidly declining ore grades. They have to dig twice as much dirt to get the exact same amount of copper.
Yeah, smelting bottlenecks in China are incredibly severe, too.
Analysts are currently projecting a global refined copper deficit of 330,000 metric tons just for the year 2026 alone. The physical bottleneck to the digital AI dream is literally a red metal. J.P. Morgan currently sees copper hitting $12,500 a ton by Q2 of this year. Goldman Sachs has published long-term targets of $15,000 a ton. If you are an investor looking for a less crowded, fundamental way to play the AI boom, you don't buy the software. You buy the physical materials required to build the hardware.
I love that angle. And before we move off of sector opportunities entirely, we really should briefly touch on what the strategy report categorizes as societal shifts.
Okay, what are those?
These are the quiet, massive macro drivers operating in the background, specifically within healthcare and agriculture. They aren't the main engine of the market, but they are very powerful undertows.
So what's moving the needle beneath the surface?
The most profound shift is the explosion of the global obesity drug market, the GLP-1 medications.
Oh yeah, Ozempic and all those.
Exactly. This isn't just a pharmaceutical story, it is fundamentally altering global consumer behavior. The market is projected to reach $150 billion by its peak. As millions of people adopt these medications, they are fundamentally eating less, drastically reducing their grocery spend, and entirely cutting out fast food consumption.
Makes sense.
That represents a massive, structural, multi-decade headwind for traditional packaged food conglomerates and fast food equities. But there is a fascinating inverse consequence. Because people are losing significant weight rapidly, they are forced to completely refresh their wardrobes.
Oh, wow. I didn't even think of that.
Right. It is quietly triggering a sustained boom in apparel and retail sales.
So within the consumer discretionary sector, it is a brutal zero-sum game. The calories lost at the drive-thru are being spent at the clothing retailer.
Exactly. The other major societal shift highlighted is fermentation technology within agriculture.
Fermentation.
Yeah. With global crop yields facing severe, unpredictable climate risks and geopolitical fertilizer shocks, the alternative protein industry is scaling rapidly. We are talking about utilizing precision fermentation to create identical dairy and protein replacements in controlled lab environments using 95% less land and a fraction of the water.
That's incredible.
It is projected to become a $30 billion market by 2030. These are highly specific, niche sector trades, but they are powerful secondary narratives operating beneath the broader macro noise of AI and tariffs.
So we've laid out the board. The high-grading trade into U.S. tech, the massive pivot into the nuclear renaissance, and the obvious structural deficit in copper. Honestly, sitting here looking at the data, it looks almost too obvious. The logic is so clean, which naturally leads to the most important question any investor can ask. Session 6. What could break this thesis, sharpen it, or become the next thing to watch? Where are the hidden trapdoors in a market that feels invincibly anchored to AI?
That is the million-dollar question. Let's start with the most acute, immediate risk to the entire global growth forecast.
The ultimate hanging uncertainty is the Strait of Hormuz, right?
Yes. As we discussed earlier, the current equity multiples, that 16% earnings growth projection, are aggressively priced for a Goldilocks scenario. The algorithmic models are assuming that the Islamabad talks will succeed quickly, the strait will reopen smoothly, global oil prices will normalize back below $80 a barrel, and core inflation will resume a peaceful downward path toward the Fed's 2% target.
But what happens to the structural board if that diplomatic fairy tale doesn't materialize?
If the talks collapse, or if the reality of those untraceable naval mines keeps the strait physically closed deep into the autumn, the entire narrative shatters. The temporary energy shock hardens into structural, deeply embedded core inflation.
And if that happens?
If that happens, the Federal Reserve won't just remain paralyzed on pause, they might actually be forced to hike rates again to defend the currency. If the Fed hikes rates into a 7% deficit environment, it would definitively break the IMF's 3% global growth forecast, and we would witness a violent, indiscriminate multiple contraction across all global equities. The high-grading lifeboat wouldn't save you from a macroeconomic tsunami of that magnitude.
Man, that is the external geopolitical sword of Damocles. But there is a massive internal structural risk building right here in the domestic U.S. economy that the consensus is largely ignoring. a risk that has nothing to do with Iran or the Fed. And that is the $1.5 trillion private credit market.
The shadow banking ecosystem.
Exactly. For 15 years following the 2008 financial crisis, traditional banks were heavily regulated and forced to pull back from lending to riskier mid-sized companies. In their absence, private credit funds stepped in. This market grew exponentially to $1.5 trillion in an environment of zero interest rates and covenant-light underwriting, meaning they lent money without demanding strict financial protections.
Right.
These massive private funds loaned billions to middle-market companies, but crucially, they heavily concentrated their portfolios in software as a service, or SaaS companies.
And those B2B software companies are the exact entities currently being utterly disrupted by the agentic AI supercycle we discussed back in session 2.
Bingo. The AI agents don't need clunky UI-heavy SaaS tools to manage workflows. They just execute the code directly. So you have these heavily indebted mid-market software companies whose core enterprise value and revenue streams are collapsing. Simultaneously, they are getting crushed by the debt service on their loans, which are floating rate and currently sitting at 3.50% or higher. They are trapped. Defaults are quietly surging across private portfolios.
And we actually saw the first tremors of contagion hit the retail investor level earlier this year, didn't we?
We did. In February and March, retail investors started doing the math. They panicked about the opaque, subjective valuations of these private software portfolios and desperately tried to pull their money out of semi-liquid business development companies, or BDCs.
Yeah, I remember that.
The funds were instantly overwhelmed by the redemption requests. Because their assets are illiquid loans, they couldn't generate the cash to pay the investors, and they had to throw up emergency redemption gates and legally freeze all withdrawals.
But if you listen to the consensus view from the major asset managers and Wall Street banks, they are aggressively pushing the narrative that this is just a slow burn. They claim the damage is isolated to a few poorly underwritten software portfolios and will absolutely not impact the broader public financial markets.
And the consensus is wildly underestimating the plumbing of the financial system. They're ignoring the transmission mechanism. It's not just a slow, isolated burn if it hits the traditional banking sector.
Yeah.
You have to ask, how do these private credit funds achieve those massive double-digit returns they promise investors?
Leverage.
Leverage. They borrow billions of dollars from traditional highly regulated banks through something called net asset value, or NAV, lending, and margin loans. Let me explain NAV lending simply. Imagine you own a vintage Rolex, and you take it to a pawn shop to borrow $10,000 cash. The Rolex is your collateral.
Okay.
But suddenly, the pawn shop owner decides the vintage watch market has crashed, and your Rolex is now only worth $5,000. He immediately calls you and demands you hand over $5,000 in cash instantly to cover the difference, or he seizes the watch.
Ouch.
That is exactly what is happening between Wall Street banks and private credit funds. The funds pledge their portfolios of software loans as collateral to the banks. If the valuation markdowns on these distressed SaaS assets accelerate because of AI disruption, the banks will panic and issue massive margin calls to the private credit fund.
And because the private credit funds are already facing redemption freezes and have no spare cash, those margin calls force them into a death spiral. They are forced to liquidate their good assets, their healthy performing loans at fire sale prices just to cover the bank's margin call.
Exactly. Forced, indiscriminate liquidations. And when a trillion-dollar industry starts aggressively dumping assets to raise cash, that stress transmits directly and violently into the public, highly liquid leveraged loan and high-yield junk bond markets. A localized, opaque private credit freeze instantly mutates into a systemic public market liquidity crisis. The banks get infected.
Which perfectly elegantly explains the extreme moves we are currently seeing in the ultimate historical safe haven assets. When you synthesize this entire board, the extreme $5 trillion fiscal debt from the OBBBA, the geopolitical chaos and naval mines in the Middle East, the political paralysis gripping the Federal Reserve, and the looming opaque threat of a multi-trillion-dollar private credit contagion, it has engineered an environment of intense systemic institutional distrust of fiat currencies.
That totally explains it.
It explains the paradox of why gold is currently trading at historic astronomical highs of $4,850 an ounce, and why silver recently broke $77 an ounce, even while the S&P projects 16% growth. Sovereign wealth funds and institutional giants are aggressively hedging against the tail risk of systemic instability. They want assets with zero counterparty risk.
And this brings us right back to the core philosophy of why we do this show and why we analyze all of this complex, occasionally terrifying plumbing, Theory D, the hopeful edge.
The hopeful edge, I like that.
If you listen to this hour-long list of macro terrors, paralyzed central banks facing criminal probes, untraceable naval mines choking global energy, forced liquidations and shadow banking, it sounds incredibly bleak. It sounds like an environment where you should just hide under the bed. But this exact chaos is actually where the active, intelligent investor finds their ultimate advantage.
Because the algorithms can't price it.
Exactly. Because the algorithmic trading models that dominate daily volume cannot instantly price in the complexity of a private credit contagion spreading through NAV margin loans. An algorithm cannot perfectly price in the physical, agonizing logistics of a fleet of minesweepers clearing a 21-mile waterway. The market is remarkably inefficient at processing these deeply complex, human-driven, physically constrained narratives, right? And because it is inefficient, because it overreacts to diplomatic headlines and underestimates regulatory friction, investors who actually do the work, who understand the causal mechanisms we've discussed today, can protect their capital and identify heavily mispriced assets. Market inefficiency isn't something to fear. It is the only reason active investing actually generates alpha.
That is the essential defining takeaway of 2026. This environment demands incredible surgical discipline. You have to stay ruthlessly anchored to the real assets and high-margin companies driving the new regime. You must watch the private credit earnings reports and BDC withdrawal rates relentlessly for signs of contagion, and you must never, ever assume the geopolitical board is settled until the physical realities on the ground align perfectly with the diplomatic headlines crossing the wire.
Perfectly said. All right, everyone, that is the brutal, unvarnished look at the 2026 macroeconomic landscape. We've covered a massive amount of incredibly heavy ground today. We've mapped the death of the 2010s, the $700 billion agentic AI arms race, the complete paralysis of the Federal Reserve amid a DOJ probe and legislative standoff, the terrifying $5 trillion debt projections of the populist OBBBA, the looming threat of shadow banking margin calls, and the absolute mess of naval mines currently choking the Strait of Hormuz and global fertilizer supplies.
It's a lot to process.
It is. If you are listening to this and you stayed with us to the bitter end of this deep dive, take a deep breath. I know your head is likely spinning from the sheer volume of structural shifts, but you need to hear this clearly. The era of simply buying a broad S&P 500 index fund, falling asleep at the wheel, and letting zero interest rates make you rich is definitively permanently over.
It's gone.
You are navigating a fractured, multipolar, highly inflationary world now. It is going to require active surgical discipline to protect your capital and find the alpha. Stay anchored to real assets, watch those private credit metrics like a hawk, and keep a very close eye on the physical reality in the Strait of Hormuz.
Yep.
And finally, to leave you on a high note, if your portfolio is currently heavily weighted in European ESG software companies and electric vehicle manufacturers, well, look on the bright side. The OBBBA just made all your overtime pay completely tax-free, which is fantastic news because you're going to need to work a lot of it to afford $100 barrel oil and $15,000 copper.
Stay resilient out there, keep your portfolios high-graded, and we'll see you in the trenches next week.
Let us know in the comments how you are aggressively adjusting your own allocations to survive and thrive in this chaotic new regime.